Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of New York and London sugar markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
New ice raw sugar in New York. The main pattern here since September 2024, so for well over a year and close to a year and a half, has been, I'm now starting to look at other patterns, has been, despite being breached and repaired, the dark blue September to December 2024 bear channel. It's currently 938 to 1437, which developed into a descending, expanding wedge pattern. We're at this time outside and on top of the dark blue upper trend line, and have been since late December last year, but the market will still not let go of this pattern, though I suspect we are coming to an end, as last week was the first week in which prices did not interact with the broken upper trend line. The mauve medium moving average, currently at 1514, in recent times has acted as a dynamic cap on prices and exhibiting a bearish zone of influence as recently as last week, whilst the green short medium moving average, currently 1480, is acting more as a support nowadays, even an attractor to the market after earlier being a capping resistance. There are two other patterns that have greatly influenced this market. The first, and the one I think may be trying to take over as the main pattern here, is the bright green late September 2024 to late February 2025 bearish shift pitchfork. I drew the original bearish Andrews pitchfork for this move some 44 weeks ago, and it seemed back then to be a better contender in showing the bearish angle of attack, but that did not last. And I finessed it into what you see now, which is the shallower bearish shift pitchfork for the same move. Today we are just above the bright green middle time, which is currently at 1446. The second pattern is another larger bearish pattern, which I had also previously spoken about, and a good contender even now in showing the bearish angle of attack. It is the longer term bright red November 23 to September 24, similar but slightly shallower bearish shift pitchfork. On this one we're a little above the bright red middle time, which is currently at 13 3/4. We also have, or seem to have had for months now, the March 2021 low in there at 1466. Now last week this acted as support. Further below we have, as I said 13 weeks ago, and I quote, we next have support on the downside on congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379. All that is needed for these to be tested is stabilization under the bright red middle time. End of quote. Well, we had that stabilization between late October and early November last year, and nothing much happened. So the market started to move back up over the bright red middle time, but was constrained in its height by initially the bright green middle time, and then what we have now, the mauve medium moving average overhead. Below this support between 1379 to 1409, well, really don't have that much support until around the 1248 level, and I'm not too confident about this supposed support down there as well. We also have a gap between 1336 down to 1320, dating from September 2020, so a lot has depended on that congestion support between 1379 to 1409. On top of all that, October was a monthly key reversal down, a bearish factor, though as I said 13 weeks ago, and I quote, can't help thinking that maybe such a pattern could be seen as a swan song. However, until otherwise, the pressure is still on the downside. End of quote. Well, even now, the pressure is still on the downside, though we seem to have undergone a small, mild halt in the decline right now, and this has prompted me to start labeling the action between mid-November 2025 today as a rectangle pattern, between about 1440 to 1535. More on this as it develops over the next few weeks. Ice Europe White Sugar in London. After all this time, there still continues to be 3 features to this market to keep bearing in mind on this daily chart. The first 3 features is the obvious: broken, repaired, broken again, repaired, and lately broken purple late September 2024 to mid-February 2025 descending expanding wedge pattern, which is currently 410.22 way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary back in January 2025 and had since then been severely tested on the top side, enough that would not necessarily classify as a descending wedge pattern after February 2025, though I continue to still keep an eye on the extensions of the purple upper trend line, as it is, bar some congestion at 425.5, the nearest support stroke resistance to this market. The one caveat to this trend line is how it was broken on the upside 9 weeks ago. But even now, the market still has not untangled itself from its vicinity, though last week was the first full week that prices did not at least touch this upper trend line at some point, broken upper trend line at some point. Next, I've also asked you 39 weeks ago to, and I quote, also keep an eye on the bright pink late September 2024 to mid-March 25 recently finessed bearish shift pitch hawk. This is a very shallow pitch hawk, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then the market initially started utilizing the bright pink middle tine of this bearish shift pitch hawk, which is currently at 443.40, as an attractor, riding prices lower in a shallow glide until early October last year, when it commenced a steeper journey lower, such that in early November last year the market had been closer to the pink lower tine for a while, and that's currently at 385.10. However, we have seen a pullback upwards since mid-November last year, and it had now been using the congestion at 425.5 as a seeming attractor. So we are in between the 2 bearish pink tines. The third feature, which developed since the beginning of September and late 13 weeks ago, saw prices above it, is the red early September to late November 2025 bear channel. This bear channel had been excellent at showing the 2025 summer into autumn bearishness of the market, including 13 weeks ago making the lowest low since December 2020. However, that same week prices broke up and out of the bright red bear channel, and late 10 weeks ago stabilized over it. As a result, 9 weeks ago I laid out possible targets for this break higher of a primary target X up in the 447.40 area, and a secondary, harder to achieve target X1 up in the 454 even area. I was not too sure about these 2 targets, as in the past the green short medium moving average, which is currently at 424 even, had been very effective at batting prices back down. But for now they still stand, though I will likely retire them by next week. I'd also note above the mauve medium moving average, currently at 435.80, which had tracked along parallel to the bright pink middle tine since last year, but has now dipped below it. This dipping has happened before, but it is worth pointing out nevertheless, as I think it will become more relevant in the coming weeks, as the market and the medium moving average try to approach each other. One final feature, and this is true in New York Sugar as well as London, and that is we might possibly be forming a rectangle pattern between here, roughly 415 even, to just over 435. Well, today we are testing the lower end of it. We're actually pushed down below it, but we haven't closed as yet. But we're testing the lower end of that rectangle. More on this as it develops. Sugar white premium spread. This one has been a very disappointing one, but perhaps, just perhaps, this may be turning into something useful. Not because of the market doing the opposite of what I thought the patterns might indicate, but because the market did nothing, or at least nothing much. 19 weeks ago I said here, and I quote, "Things seem to be trying to resolve themselves into a pattern. And over the intervening weeks," and that's the end of the quote, "and over the intervening weeks they seem to be doing just that, though not always the way I imagined they would, or either into a clear resolution. You see, I thought we might be moving towards, as I cautioned for a number of months, and again I quote, I have a fear, and it's a real fear, that the whole February 25 today action may be trying to form a possible diamond pattern. End of quote. Now I continued and I once again quote, this would be a large pattern in time, probably from February to November this year, so that's 2025, and in height, roughly between just under 100 up to 150. It is too early to say if this is happening, but I would urge you to keep an eye on such a possibility. End of quote. That possibility looked real until 19 weeks ago, when the market dropped down and below what I thought would be the lower bullish trend line, which is highlighted in dark blue. The market not only dropped below the trend line, and let's be honest, it is an unjustified trend line, but went on further to drop and close below the gold long moving average, currently at 109 even, stabilizing further down, dropping and closing below a new support line, which is the bright red neckline, currently at 97 3/4, of a new simpler pattern which the market opted to utilize instead of the more complex diamond pattern. It became a February to early October head and shoulders top. The issue I had and still have with this pattern is that we are now past the early stages and we really haven't confirmed a move either higher above the gold long moving average or lower sufficiently below the bright red neckline extension so far. I chose 15 weeks ago to lay out some potentials below for such a head and shoulders top pattern just in case. Thus, a primary target X is down in the 70 even zone, for secondary harder to reach target X1 down at 43 3/4. You'll easily note that the primary target X is at the lower end of the congestion seen between September 2024 to January 2025, between approximately 70 even to 85 even. Since then, nothing much has occurred until perhaps today and this week. I've yet to verify if this move lower is the real deal, but it is encouraging. It all still comes down to what I said 15 weeks ago when I said, and I quote, only concerted, consistent and long-term moves over the bright red neckline, and ideally over the slowly rising long moving average, could possibly assuage the bearish potential at least as far down as the 70 to 85 congestion. End of quote. We had in recent times been half there and half not there, and the moves over the last 11 weeks just exemplifies these half in and half out contradictory courses of action until possibly this week. It looked like indecision, but on a much larger scale, more than just a weekly chart can really show. But maybe, just maybe, this is coming to an end. This also raises question, and it's too early to say for sure on this one, but it may be that the whole mid-September 2025 today action could be a bearish halfway hesitation. And if that were to be the case, then we'll be looking at a move down to just under the 65 even zone, and that is something to ponder.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.